What's up, everybody? This is Sunko, the Korean bro. Today is 2023, June 19th. And let's see. Is it too late to buy Odobi stock? I love this AI stock, but its valuation is too lofty for me right now. Investors are convinced they found the next Chipotle. Uh, the grim reality of Joe Biden's four-point plan to change Social Security. Um, mm, Okay, let's see. Is it too late to buy Adobe stock? Now it talks about Adobe stock, okay? Hmm. Adobe's quarter second earnings easily beat analyst expectations. It raised its revenue and earnings guidance for the full year. Its stock isn't cheap, but it could deserve a premium valuation. Hmm. Adobe stock. Let's see. Okay. Adobe posted an impressive earnings report on June 15 for the second quarter of fiscal 2023, which ended on June 2nd. The cloud software provider's revenue rose 10% year over year to $4.82 billion and exceeded analyst estimates by $50 million. Its adjusted EPS grew 17% to $3.91 and also cleared the consensus forecast by $0.17. Hmm. Okay, for the full year, Adobe expects its revenue to rise 9.3% to 9.9% as its adjusted EPS grows 14.2% to 14.9%. Both of those estimates were raised from its prior outlook for 8.9 for 8.5% to 9.6%. Uh, that beat and raise quarter brought back the bullish and drove Adobe stock to new 52-week high, but is it too late to invest in that high-flying stock after its near 50% rally this year? Let's take a fresh look at its business side. Adobe's growth rates are stabilizing. Adobe's operating margins should expand in the second half. Expand in the second half. Adobe's gross margin still expanded 20 basis points. It's generating plenty of cash and buying back a lot of shares. Generating plenty of cash and buying back a lot of shares. Adobe's operating cash flow rose 5% year over year to $2.14 billion uh, in the second quarter, and it bought back 2.7 million shares. It still has $4.15 billion remaining in its current $15 billion buyback plan, which expires at the end of fiscal 2024. But at $500, Adobe stock isn't cheap at 32 times this year's adjusted EPS. Its insiders also sold about 35 times as many shares as they bought over the past 12 months. For reference, Salesforce, which competes against Adobe's digital experience division, is growing at a similar rate but trades at just 28 times forward earnings. Yet Adobe's buybacks, which reduced its share count by 4% over the past 3 years, suggests it isn't overvalued. A stable growth steak ecosystem, future gains from Figma, and new generative AI features could just all justify its higher valuation. Okay, let's dive deep into NVIDIA, okay? So let's see. Okay. Nvidia's financial metrics don't compare to other members of the $1 trillion club. Their stock trades at an unbelievable premium. The implied growth of Nvidia at this stock price is absurd. When it comes to artificial intelligence stocks, few draw more attention than Nvidia. Its graphics processing units are the most popular to train AI models, making the stock a nearly perfect picks and shovels play for the AI revolution. I say nearly perfect because every stock comes with a price tag, and Nvidia's is just too expensive for me. If you are curious about what Nvidia's current valuation implies, read on to find out. Mm. Nvidia has a ways to go before looking like a $1 trillion company. Mm. Everyone knew Nvidia would benefit from an AI boost, which is why the stock price rose 47% from February 22nd to May 24th. Between Nvidia's quarterly reports for the fourth quarter of fiscal 2023 and the first quarter of fiscal 2024. Despite Nvidia's revenue falling 21% in quarter four, however, no one expected as massive a jump in demand, as Nvidia expects second quarter revenue to be about $11 billion, a 64% rise. While that's reason to celebrate, perhaps investors applauded it a little too much, as the stock is up about 30% since their guidance release. Highly valued. That's an expensive valuation for a stock now, let alone one that can only achieve those numbers in 3 years by doubling its revenue. If you adjust those metrics to a more reasonable 10 times sales and 27 times earnings, that will put Nvidia's stock price today at $261, a 34% downside, just to have a reasonable valuation in 3 years. That's way too rich of a valuation for my liking. And even though Nvidia's products are great and the company will see significant growth due to AI demand, there isn't any room for the stock to grow. Because of that, I have to pass on Nvidia for now. But if its price comes back down to earth, I'd like to change my stance. So this author thinks that it's highly valued compared to its revenue. I mean, its current price is too high. Mm. And like, what is it? That would imply stock is trading for 15 times sales and 41 times earnings. The next one was Chipotle. At a unit level, the purveyor of Greek cuisine is comparable to the burrito slinger. Overall profitability is not in the same ballpark, so white hot growth resulting in an IPO glory. The restaurants are very profitable. Top five stocks: Apple, Tesla, TSMC. Let's go. Let's get deep into TSMC. Okay. Okay. If semiconductor chips are the building blocks of technology, Taiwan Semiconductor is the peak and shovel investment for the technology sector. The company is the world's leading semiconductor manufacturer, responsible for building chips for many of the world's biggest semiconductor names, including Nvidia. Taiwan Semiconductor builds nearly 60% of the world's semiconductor chip supply. Okay, this article is what I read last night. With such massive manufacturing capacity, the company can build chips better and for less money than most of its competitors. Plus, the world's appetite for semiconductors should only grow over the next decade and beyond. The global semiconductor market is worth approximately $600 billion. It could grow beyond $1 trillion by the decade's end, which could spell years of growth ahead for the world's leading chip maker. Berkshire Hathaway, Markel, Amazon. Let's look at Amazon. Okay. Mm, let's see. Amazon is making tweaks to its business to decrease cost and increase efficiency. The company is also looking to profit from the ongoing artificial intelligence boom. Amazon has many other growth opportunities at its disposal. Even in a market cap above $1 trillion, the company still hasn't peaked. The stock market continues to perform well this year despite fears of a coming recession. While this cloud be the early innings of a new bull market, especially following last year's downturn, nobody can tell for sure. However, a sustained bull run will come eventually. That is one thing we can bet the farm on. And there are plenty of equality stocks to consider buying before that happens. One that looks particularly attractive is Amazon. Let's consider why the tech juggernaut remains such an excellent option for investors. Recovering from a challenging year. Okay, Amazon faced a barrage of headwinds last year, culminating in the first annual net loss it has since 2014. Consumer activity declined, leading to lower sales for its e-commerce business than it would have typically generated. Business strapped for capital, reduced investment in cloud computing, and expenses and costs partly related to inflation were up. That's bad combination for any company, but Amazon is turning over a new leaf this year. It has gone through several cost-cutting initiatives, including layoffs. To decrease coach in the first quarter, the company's revenue increased by 9% year over year to $127.4 billion. Amazon's net loss of $3.8 billion in quarter first 2022 swung to a net income of $3.2 billion this time around. Things should continue to improve for Amazon, which is why its shares are up by 50% already this year. But the company's long term prospects are even more appealing. Hmm. Okay. While there is no stopping Amazon, Amazon's biggest strength isn't its leadership in several fast growing industries ripe for growth. Size or the amount of cash it generates. Of course, all those things are important, but they are all the result of something more fundamental. Amazon has created a culture that enables it to identify exciting growth opportunities and expertly pounce on them. That's what it did with e commerce in its early days and with cloud computing. Now, Amazon is seeking to do the same with the newest technological revolution, artificial intelligence. The company recently announced Amazon Bedrock through its cloud service, Amazon Web Services. Hmm. Bedrock will give developers the tools to build generative AI models. The company recently announced Amazon Bedrock. Bedrock will give developers the tools to build generative AI models. Uh, Applications that take in a set of cores and generate text, images, videos, etc. ChatGPT is an example. To help speed up the development of new generative AI application, Amazon will provide foundation models, the backbones behind applications like ChatGPT. Foundation models are trained to identify patterns on large data sets and fine tuned to perform various tasks. Building foundation models are expensive and time consuming. Developers will be able to save time and money in developing generative AI applications thanks to Bedrock. AI is, of course, on the rise. While estimates vary, they all promise an exciting future for the industry. Grandview Research predicts that the generative AI market will reach $109.7 billion by 2030, clocking in at an impressive compound annual growth rate of 35.6%, Jordan. Amazon could be a big winner. We can also expect the company to continue making headway elsewhere, from its attempt to make waves in healthcare to its dominance in e-commerce and the broader cloud computing industry. Attempt to make waves in healthcare. And the broader cloud computing industry, both of which are still growing rapidly. That's not to mention Amazon's presence in music and video streaming. AWS also benefits from high switching costs. Amazon should succeed in delivering plenty more years of market beating performance given all that it has going for it. Okay, to sum up, it has gone through several cost cutting initiatives, including layoffs. Amazon Bedrock, through its cloud service AWS, it will give developers the tools to build generative AI models. Its attempt to make waves in healthcare and to its dominance in e-commerce. Upstart Holding, GoPro. Okay, let's start with Upstart Holdings. Okay. Hmm. Okay, a steep decline in value created an intriguing risk-reward proposition for these two stocks. When a stock crashes by more than 90% from its all-time high, investors will be right to question whether there is a structural problem with its underlying business. In most cases, there is, but sometimes companies also succumb to economic factors outside of their control. And the two stocks featured here have lost between 90% and 95% of their value, but they are in the process of overcoming a mixture of internal and external challenges. If they succeed, investors who buy in today might be paying a rock bottom price with the potential for substantial gains in the future. Upstart, believe it or not, shares of Upstart Holdings are up a whooping 187% in 2023. But the stock fell so sharply over the last 2 years that the game barely made a dent in its overall losses. So it's still down 90% from its all-time high. The tech company uses artificial intelligence to originally launch for banks, credit unions, and car dealerships. Investors grew concerned when the Federal Reserve embarked last year on the most aggressive campaign to high interest rates in its history because credit conditions rapidly deteriorated. Standing loan defaults climbing and consumer demand for loans plunging. Opera was affected on both counts, but it recently released data that proves its AI algorithm can deliver quality originations even in this tough environment. They released it proves its AI. As a result, in the first quarter of 2023, uh, the company had a record high nine on landing partners, which was nearly double the number it had at the same time last year. Hmm. Okay. The first quarter of 2023. Okay. Which was nearly double the number it had at the same time last year. Partners, which was nearly double. In a vote of confidence, some of those partners just committed more than $2 billion in funding to ensure Upstart can meet future loan demand. The platform's algorithm is capable of analyzing 1,600 data points to determine a potential borrower's creditworthiness. The platform's algorithm data points to determine a potential opposed to philosophical scoring system, which only considers five. And because Opera is powered by AI, can process the data instantly to deliver an immediate approval 84% of the time. It can process the data instantly to deliver immediate approval. It can process the data instantly. Time that's a major time and cost saver for banks because manually processing that much information would take a human assessor days or weeks. The demand for loans isn't expected to recover in 2023. As a result, Wall Street analysts predict Upstart's full year revenue will come in at $549 million, which would be a 34% drop compared to 2022. The revenue is expected to rebound strongly to $781 million in 2024 once the economy gains some upward momentum. Now that Upstart has weathered this difficult period and has the unquestionable support of its lending partners, there is a good chance its stock will continue to recover into next year. In the long term, the company believes it has a $4 trillion opportunity in the markets for personal loans, automotive loans, business loans, and mortgages. So investors might wish they had bought in while stock was still heavily written down. Okay. Now, Paycom Software Active Raffen. Electrical. Okay. And okay, hold on. Now, what I'm going to look at is hmm, electromechanical vehicles. Electromechanical vehicles. Electromechanical vehicles. Engaged in the development and manufacture of electric vehicles. It operates through electric vehicles and a custom-built vehicle segment. Custom-built electric vehicle segment develops and manufactures electric vehicles for mass markets. The custom-built vehicle segment offers custom-built vehicles. The company was founded by Jerry Crow and Henry R. Reinze on February 16, 2015. Is headquartered in Burnaby, Canada. Okay, electromechanical stock is climbing thanks to excitement surrounding its recently passed infrastructure bill. Let's see. Despite recent momentum, the electric vehicle company stock is still down roughly 35% year to date. Despite recent momentum, okay, what happened? Shares of electromechanical vehicles continue to climb higher on Monday's trading. The company stock ended the daily session up 8.1%. Hmm. It's barely mentioned in this. Okay, this is barely mentioned in mollyfood.com. So even after rising 44% this past week, electromechanical vehicle shareholders sold down 88% over the past 5 years. Over the last month, the electromechanical vehicles has been much stronger than before, rebounding by 61%. But would that heal all the wound inflicted over 5 years of declines? Unlikely. In fact, the share price has tumbled down and mountain to land 88% lower after that period. While the recent increase might be a green shoot, we're certainly hesitant to rejoice. The important question is if the business itself justifies a higher share price in the long term. We really hope anyone holding through that price crash has a diversified portfolio. Even when you lose money, you don't have to lose a lesson. On a more encouraging note, the company has added US $29 million to its market cap in just last 7 days. So let's see if we can determine what's driven the 5 year loss for shareholders. Because electromechanical vehicles made a loss in the last 12 months, we think the market is probably more focused on revenue and revenue growth. At least for now, shareholders of unprofitable companies usually expect strong revenue growth. Some companies are willing to postpone profitability to grow revenue faster. But in that case, one does expect good top line growth. The last half decade, electromechanical vehicles saw its revenue increase by 62% per year. That's well above most other pre-profit companies. So it's not at all clear to why the share price sunk 13% throughout the time. It could be that the stock was overhyped before. We'd recommend carefully checking for indications of future growth and balance sheet threats before considering a purchase. Okay. The graphics below depicts how earnings and revenue have changed over time. This free interactive report on electromechanical vehicles balance sheet strength is a great place to start if you want to investigate the stock for a different perspective. Investors in electromechanical vehicles had a tough year with a total loss of 36% against the market gain of about 20%. Even the share price of a good stock drops sometimes, but want to see improvement in the fundamental metrics of a business before getting too interested. Unfortunately, last year's performance may indicate unresolved challenges, given that it was worse than the annualized loss of 13% over the last half decade. Huh. Electromechanical vehicles. Now it's up 44%, but people are doubts on its potential. Hmm. Not so good. Not so good. Okay. What else do we have? Let's look at Bach at this point. Okay. Bach, the company named Bach. Okay, best pet food stocks for animal lovers. Chewy, Bark, Chewy. Chewy has probably gotten more attention than any other pet food stock during the pandemic, and for good reason. The company has become synonymous with e-commerce in the pet product sector for customers and investors alike. Mm, okay. The original Bart company may be better known by the name of its best known product, Bart Box, a monthly subscription service. It provides premium toys. The company went public through a SPAC in a merge completed in June 2021. Following the growth in e-commerce and a wave of interest from the pandemic, Bart saw revenue jump 69% to $378.6 million for the fiscal year ending March 31st, 2021. Uh, Subscription shipments were up 53% to 11.6 million, and it narrowed its adjusted EBITDA loss from 17.8 million to 7.9 million, showing steps toward profitability. Bart offers a number of subscription products, including Bart It's, a monthly meal plan, Bart Bright, a health subscription that starts with dental kit, a number of subscription products, including Bark It's, a monthly meal plan, Bark Bright, a health subscription that starts with a dental kit, and Super Chewer durable dog toys for larger dogs. Bar aims to continue growing by expanding to new categories, increasing brand awareness, and broadening its subscriber base. With its strong growth and unique subscription model to select product for customers, Bar could have promising future ahead. Mm, what is Bar so different from others? Mm. Long-term trends for the pet industry are exceptionally favorable for Bar. Consumers continue to spend on their pets even as they cut back on their own expenses. Yes, consumer continue to spend on their pets even as they cut back on their own expenses. However, there are only so many toys adult needs can grow consistently. Can't run with the big dogs. Only 15% are reducing what they spend on Fido and Fifi. It's an environment that should see Bart thriving yet. The market value is at just a fraction of its $500 million in annual sales. So let's take a look at whether this pet-oriented subscription box business is a buy. Wait, focusing exclusive on dog owners, Bar sends a monthly bark box to member based on the size of their dog. The package include selection of pet toys, treats, and shoes for $35 a month. Despite the willingness of pet parents to keep spending on their pets, Bar's fiscal third quarter revenue of $134 million fell 5% from last year as sales were apparently pulled forward into the second quarter. Shipments dropped 4% as active subscriptions dipped around 2%. Okay, that's about it. This is it for today, and I'm gonna see you tomorrow. Okay, have a great night. It's already 12:12 midnight. Gotta go to bed, and happy Monday night, and see you, and have a great night. Okay, bye bye.